Hi there, it's Mattia, connected from Milan. I'm from eFinance Consulting Italy, and I'm part of the Titanium team, the Replier team behind the Reply Investment Challenge. This is the first part of the series of everything you need to know about this challenge, which is focused on sustainability. Let's get started. This series of video aims to help you improve your knowledge of capital markets. Given how broad this subject is, we have divided into two key sections. So we are going to first talk about the definition and the main traits of capital markets, and then explain what an asset class is and its main categories. So let's deep dive into the basic of capital market. Capital markets are a physical or digital place where several financial needs are satisfied. In terms of financial needs, there are two kinds of people. Those who have money to invest and those who are looking for investors. The first one are the supplier of funds, while the second ones are the user of funds. Capital markets provide a place for these two parties to help each other. So, supplier of funds want to invest their money to, among other things, protecting from inflation decreasing its value, but also to earn a return on their investments. On the other hand, user of funds want financial resources they don't have to buy assets or finance infrastructure investments and company growth. As supplier of funds receive interest, so user of funds pay interest. Capital markets is where long-term financial instruments such as bonds, equities, mutual funds, and derivative instruments are traded. And now it's time for asset class and its main categories. Asset classes are a group of several investment instruments with similar mechanism and regulatory frameworks. The most common assets are equities, known as stocks, fixed income, known as bonds, cash and cash equivalents, and derivatives. However, the mix of asset classes can change over time when new products are introduced. For example, now it's time for cryptocurrencies. Every asset class has different risk and return, and usually these two topics are positively correlated. Higher the risk, higher the return, and vice versa. Historically, equities are the highest risk and return, while cash is the safest and lowest risk. Asset classes are made up of instruments that usually behave similarly to one another, with a strong correlation among them. A new description defines an asset class as being made of instruments that react similarly to the same risks. On the other hand, there is often very little or no correlation at all among different asset classes. Typically, it's not advisable to invest in just one asset class, but better to create a portfolio with several asset classes to offset possible losses from one class with profits from others. This is fundamental to effective portfolio management and is known as diversification. Additionally, we have some tips and tricks on this topic for you. You can find them all on the learning page in the challenges platform, but we can start revealing some of them right now for you. First of all, some assets are more liquid than the others. This means they can be converted into money faster, but this does not mean they are more profitable. No one asset class is better than the rest. Each one has its own intrinsic characteristics and appeal to investors for a variety of reasons. Remember, risk is key when it comes to choosing asset classes. Know always what risk affects what assets. There is no perfect combination of asset classes, but there is an optimal combination to achieve the best yield. It's now time to move to the next topic, fixed income. A fixed income security is an investment that provides a return in the form of fixed periodic interest payments, along with the eventual return of the principal, that is the original amount loaned, at maturity. Investors gain from difference between the face value and the price, since usually the purchase price is lower than the face value amount, plus the interest they receive during the months year of the investment. Fixed income securities pay investors a fixed amount of interest in the form of coupon payments. There are many bonds known as fixed income products. Government and corporate bonds are the most common. If a company goes bankruptcy, fixed income investors are paid before common stockholders, but the returns are lower than other investments. Also for fixed income, here are some tips and tricks for you. Different bonds are linked to different risk levels. For example, government bonds are considered less risky than corporate ones. So when choosing an investment, look at the credit rating of the bond and the underlying company. Bonds with ratings below BBB are of low quality and considered as junk bonds. Remember, as always, the lower the risk, the lower the return. A simple formula to evaluate the current price of the bond is to discount the cash flow until maturity using an interest rates valuing the principal that reflect the price of money. The discount is obtained by dividing the cash flow by the interest rates. Remember, bond prices can increase and decrease over the life of the bond. But if an investor holds the bond until maturity, these movements are irrelevant, as the investor will receive the face value of the bond when it matures. Okay guys, that's all for this episode. I hope you enjoyed it and find it useful. For further questions or doubts, you can contact us at challenges@reply.com. If you haven't done it yet, register for the Investment Challenge 2022. Have fun and see you at the next episode.